6 AI investing mistakes that cost small businesses $12,400. One client lost his entire Q3 profit because he trusted an AI portfolio tool's default settings. $17,000. Gone in 6 weeks. And here's what makes me angry. The AI wasn't broken. It was working exactly as designed. Marcus just didn't know that the tool was optimized for aggressive growth portfolios, not the conservative cash flow strategy his landscaping business actually needed. The default settings assumed he was a 25-year-old tech worker, not a 52-year-old business owner 3 years from retirement. I've spent the last 14 months tracking how small business owners use AI investing tools. I interviewed 43 entrepreneurs. I analyzed their portfolios, and I found the same 6 mistakes appearing over and over again. Mistakes that cost an average of $12,400 per business. Some lost more. A few lost everything they'd invested. Now, mistake number 4 is the one that shocked me most, because it's the exact opposite of what every AI tool tells you to do. And mistake 6. That one is responsible for more losses than the other 5 combined, but almost nobody talks about it because the AI companies definitely don't want you to know. So whether you're already using tools like Wealthfront, Betterment, or newer AI platforms, or you're thinking about starting, this breakdown might save you from becoming the next cautionary tale in my research notes. The first mistake is treating AI recommendations as financial advice instead of financial suggestions. There's a massive legal and practical difference here. Sarah runs a boutique marketing agency in Phoenix. Last February, her AI investing app recommended she increase her exposure to tech stocks by 31%. The app showed beautiful charts, probability calculations, even cited market trends. It looked authoritative. So Sarah moved $48,000, basically her entire business emergency fund, into the recommended positions. Within 90 days, she'd lost $11,200. When she contacted support, they pointed her to page 47 of the Terms of Service, the one that says, and I'm paraphrasing, "This is not financial advice. Past performance doesn't guarantee future results. We're not responsible for your investment decisions." Here's what Sarah didn't understand, and what most business owners miss. AI tools are pattern recognition engines. They analyze historical data and identify correlations. They cannot account for your specific tax situation, your upcoming equipment purchases, your Q4 cash flow needs, or the fact that your biggest client is about to renegotiate their contract. The takeaway? Before acting on any AI recommendation, run it through what I call the "what does the AI not know" filter. Write down 3 things about your business situation the algorithm couldn't possibly factor in. If those 3 things would change your decision, ignore the recommendation. But this brings us to mistake number 2, which is actually the opposite problem, and it cost one business owner even more than Sarah lost. Mistake number 2 is overriding AI recommendations based on gut feelings without any data to back it up. David owns 3 laundromats in Ohio. He started using an AI portfolio tool in late 2022. Every single time the algorithm suggested rebalancing toward bonds, David rejected it. Why? Because his buddy at the gym said bonds were dead money. Because he felt like tech stocks always come back. Because the AI's conservative approach didn't feel aggressive enough for his goals. In 18 months, David's portfolio underperformed the AI's original recommendations by $14,000. He paid for a sophisticated tool, then systematically ignored it based on locker room financial advice. Now, I'm not saying the AI is always right, but here's the framework that actually works. Only override AI recommendations when you have specific information the algorithm doesn't have access to. Not feelings, not hunches, not what your brother-in-law said at Thanksgiving. For example, If your AI suggests buying shares in a company you happen to know is about to lose their biggest contract because you're in the same industry, that's valid override data. But I just don't trust bonds right now? That's not data. That's noise. The sweet spot is treating AI as one voice on your personal board of advisors. It gets a vote, not a veto. And it definitely doesn't get ignored because someone at the gym has opinions. Now, mistake number 3 is the one I see destroying the most money in the shortest time period. And honestly, it's the mistake that made me completely rethink how I create content about AI tools. The mistake is using voice clone AI to consume financial content faster without verifying the original sources. Let me explain. There's this growing trend where business owners use AI tools to convert long financial reports, earnings calls, and market analyses into quick audio summaries. The idea is efficiency. Listen while you commute, absorb more information, make faster decisions. But here's what happened to Michael, who runs an HVAC company in Texas. He used an AI voice tool to summarize a 40-page analyst report on energy sector stocks. The summary told him the analyst was bullish on 3 specific companies. Michael invested $19,000 based on that summary. Except the AI had hallucinated. The original report was actually cautious about those companies, with specific warnings buried in the methodology section. The AI voice summary missed the nuance entirely and presented uncertainty as confidence. Michael lost $8,300 in 11 weeks. Now, I actually use AI voice tools myself, specifically 11 Labs, for creating content and consuming research faster. The difference is verification. If you're going to use tools like 11 Labs, you can check it out at try11labs.io 2PU1 UBO09Y92JL1. The key is using them for efficiency on information you'll verify, not as a replacement for reading the actual source when money is on the line. The rule I follow: AI audio summaries for initial screening, human eyes on original documents before any investment over $5,000. Mistake number 4 goes against everything the AI platforms tell you, and it cost Jennifer her entire first-year investment gains. The mistake is trusting automated rebalancing during high volatility periods. Jennifer owns a chain of yoga studios. Her AI tool was set to automatically rebalance whenever her portfolio drifted more than 5% from target allocation. Sounds smart, right? Set it and forget it. Except during last year's banking sector panic, her portfolio drifted, triggered a rebalance, drifted again the next day, triggered another rebalance. In 9 days, her account executed 14 automatic trades. The transaction costs alone ate $2,100. And because the algorithm kept selling at lows and buying at peaks, trying to maintain allocation, she locked in losses she would have recovered if she just waited. The fix is simple. Set your rebalancing to manual during any week the VIX index goes above 25. Check it yourself. Make the call with human judgment about whether this is a temporary storm or an actual shift. Mistake number 5 is faster to explain but equally expensive. Using the same AI tool's risk assessment for both business investments and personal retirement accounts. They require completely different time horizons. Your business might need that money in 18 months. Your retirement account won't be touched for 20 years. But most AI tools apply identical risk models to both unless you create completely separate accounts with different stated goals. Robert learned this when his AI tool treated his $90,000 business operating reserve